But we have an incredible panel. I've spoken to all of these gentlemen over the last couple of weeks and was really blown away by the quality of the presenters, the quality of the companies. And although the title of this section is the crowdfunding marketplace, of course there are many, many marketplaces, and Jason was touching on that. He mentioned actually a number of the companies, a number of the deals. It's amazing to see the pace of change that's going on in this marketplace. And it seems almost that crowdfunding is becoming the solution to everyone's problems. We saw that F1 is looking at funding itself now, Formula One. With crowdfunding, it's going to solve Ebola. Of course, classic economic theory tells us that as long as supply and demand grow in concert with each other and are relatively imbalanced, then the market overall will continue to expand. And I think we're starting to see that really play out across many, many markets. But of course, there are headwinds. The regulators across the globe are weighing in. We heard that again from Jason. And some of them perhaps clumsily and helping to slow the market in some cases. What else could change the dynamic of the marketplace? We've heard about the entrance of institutional investors. Can institutions and investors coexist in these various marketplaces? Will we see more deals such as the CircleBack Jeffries deal? Will the lack of a secondary market or slowly evolving secondary market eventually take its toll? So growth is a key question when we think about the marketplace, but growth always comes at someone else's expense. Who might the losers be in the next 5 or 10 years? Me and my team are spending a lot of time thinking about that because we currently supply the potential losers. Is it the investment banks, the VCs, the high street and regional banks, the mortgage lenders, the credit card issuers, the exchanges? I'm sure we'll get into that in a moment. Okay, so enough from me. Let's hear from the experts. And I have 3 broad questions which will apply across the team. And I hope that we'll hear somewhat different answers, especially given the fact that the representatives occupy somewhat different spaces or operate in different markets. So to kick off, I'd like each of the panelists to introduce themselves, to provide their background and their role in their firm and what their firm does and the marketplace that they occupy. And then please talk about the specific dynamics driving both the supply and demand for your marketplace. How has that changed over the last 18 months? We've heard a lot about change. Where are the imbalances coming out, and how are you expecting the market or your firm to start to address these imbalances? So why don't we start with John on this side and we'll move across.
You want us to answer the question as well as give our background?
Yes, a background and then question.
Okay.
And then we'll do the next.
So my name is John Higgins. I'm a director in the Strategic Partnership Group at Prosper Marketplace. Prior to my current role at Prosper, I helped build out the institutional funding platform at Prosper. Prior to that, I spent 6 years in the alternative investment industry. Prosper is the nation's second largest peer-to-peer lender. We match borrowers and lenders through an online marketplace. Actually, peer-to-peer is kind of a misnomer today. It's more of just a marketplace. If you look at the way the business has developed and our growth, as Luan said, we're growing very, very rapidly. We went from 9 million in monthly originations in January of last year to 172 million last month. With this growth, I think a big driver for this, and this gets to your question, is the supply-demand imbalance. You've seen a tremendous amount of demand from institutional and individual investors to fund assets in these marketplaces. Once they have credibility and once the marketplace has credibility in its underwriting model and the confidence from the investor community, there's essentially not unlimited, but close to unlimited capital to fund these loans.
We started 2 years ago. We were founded and are based in Israel. We're focused on equity crowdfunding, which means we invest in typically young technology-based startups in Israel, though we've expanded over this past year internationally. 8 of our last 12 investments, we've made 55, have been based in the U.S. We've raised 70 million, which puts us at the forefront of the equity crowdfunding, obviously much smaller than the peer-to-peer marketplace lenders, I should say. But we are one of the most active. We did have the first IPO in the equity crowdfunding industry, a company called Rewalk Robotics, which listed last month on the NASDAQ, market cap close to $300 million. So investors that came to OurCrowd little less than 2 years ago saw a 4 to 5x return on their money in 2 years. Liquidity If they were to sell today, there's a 6-month lockup period. I would disagree a little bit with what Jason said in his remarks, in that at least our struggle is not finding new investors, it's finding new good deals. And they're sort of connected, obviously. In the equity crowdfunding space, it's very hard just to put up a pure marketplace and just let any deal in. The quality of the marketplace, because it's such a risky asset class, is very important. So we spend most of our time, we have a deal flow team that looks and scrubs deals. We only put up 2% of the deals that meet our criteria. We invest our own capital in it, so we ensure that we sit on the same side of the table as investors, and then open it up to the crowd. So in our way, we acknowledge and signal to our investor base that yes, this is a risky asset class. You are going to lose your money in 40% of the deals probably, which doesn't sound like a great pitch, but that's the truth. And to be successful doing that, you need diversification. So if there is a limiting factor, I would say in our growth, it's being able to scale internationally, our ability to attract good deals to the platform. We are now seeing deals where we're co-investing alongside some of the best VC companies in the world. So the Battery Ventures, the Sequoias, we're now investing alongside them. That took about 2 years to get to that point. They definitely saw us as competitors initially. There's one other piece that we see as growth, which hasn't necessarily been mentioned, but we did have GE Ventures make their first investment on our platform. They came and invested in an Israeli med tech company called Moderator. So we also see interest from corporate investors.
Thanks, Zack.
Hi everyone, my name's Sohin Shah. I'm the co-founder and COO of iFunding. iFunding's a crowdfunding platform for real estate. We went live about a year back, and since then we've crowdfunded about 25 different projects for a total of roughly $26 million. We started off focusing purely on equity, but over the past 2 months we've started offering debt as well. Single family fix and flips was the bread and butter of what we did. We've also moved on to new construction and multifamily units now. Just to speak about demand and supply, I think a lot of it a lot of the attention that our industry receives is thanks to sister industries like the alternative financing industry, where Prosper and Lending Club have done such a good job of getting credibility to unsecured loans. And people are sort of interested now in looking at how crowdfunding would shape out to be. With Lending Club going for its IPO, I think it's just going to be a lot better for new companies like ourselves to be able to grow in this industry. Just to speak a little more about iFunding, we did launch the first mobile app for crowdfunding in real estate a couple months ago. And most recently, we also opened an office in Singapore to be able to source Asian capital into US and expand internationally.
Hi, I'm Ryan Feit. I'm the CEO and co-founder of SeedInvest. SeedInvest is a leading equity crowdfunding platform that's based here in New York. In terms of a couple just differences about SeedInvest, so one is we're highly vetted, so we historically have accepted about 2% of the companies that have applied through our platform. In addition, our business model is different than most, I guess, folks out there. We are free for investors, so we don't charge carried interest or anything like that. We charge companies commission on whatever is successfully raised, so more similar to sort of the Kickstarter model. And in terms of just, I guess, the supply and demand imbalances that we see, I would echo what was said earlier. I mean, it's not at least getting more deals on a platform in the equity space. It's getting more high-quality deals. And then certainly on the other side, I would say getting capital is always important in terms of growing both sides of the marketplace. And I think what we see is probably not that dissimilar to what Prosper probably saw back in 06, 07, where getting capital onto the platform was probably one of the challenges in growth. But what we've been seeing in the past 9 months is more family offices and institutional guys that are funding deals on our platform, bridging, I would say, to get to larger institutional checks. So just in terms of metrics, the average investment on our platform is about $31,000. We've had people invest as little as $5,000 this year. We've had family offices in the past few months invest $550K, $750K. Someone invested $1.8 million this morning before I got here. So we're seeing bigger check sizes, which is certainly interesting. And it's a balancing act in terms of continuing to scale, but making sure you keep quality high, which is always a challenge as you're growing a marketplace. And one thing in terms of how we're addressing growing both sides of the market, Jason alluded to it earlier, which is we recently, a few weeks ago, partnered with Gust. Gust has been around for about 10 years. They work with the vast majority of all the angel networks in the world, and they've got about 8,000 to 10,000 startups that apply every month on their platform, and about 50,000 angel investors on their platform as well. So that partnership with Gust enables us to get access to a lot more deal flow and see which deal flow is sort of bubbling to the top and getting led by angel groups on their platform. And then on the flip side, allows us to kind of combine our 5,000 angel investors with their 50,000, so that there's a lot more potential liquidity on the platform as well. So that's how we're addressing things as we scale.
Go ahead, Michael.
Michael Solomon, CEO of CircleBack Lending. My background is in legal and financial technology companies. CircleBack is very similar to Prosper and Lending Club, in which we work with investors on the one hand and borrowers on the other hand. One of the things that we did when we came into the marketplace, and by way of background, I started the third peer-to-peer lender in the United States called Loanio back in 2007. And it wasn't the best time to launch in 2008 for a number of reasons. But one of the things that I've learned along the way and what we've seen in terms of trends, and certainly over the last 18 months this has really heated up, is that on the investor side of the equation, it's really gone and shifted from a retail marketplace to more of an institutional marketplace. So one of the things that we did when we launched was we deliberately decided that for our business model it didn't make sense at this stage of development in the evolution of P2P lending or marketplace lending to really get involved with retail. So we just are focusing on institutional investors. On the borrower side, when you're talking about supply-demand issues, we're seeing now that because there seems to be a lot of new players being introduced to the marketplace every day, in addition to all of the traditional players that are now also trying to figure out, well, how do we shift gears and use some of the customer acquisition strategies that are now being used by the fintech companies that are in the game. You're finding that there's more price competition, more price sensitivity in the marketplace. And I think that many of us have to try to carve out exclusive niches now when dealing with distribution channels and acquiring new borrowers, and also differentiating product. And John also pointed out that Lending Club has now moved their product or extended their product line into small business, and I think you'll continue to see that. There's a lot of activity in a lot of other sectors that you'll see here, as well as the other marketplace lending conferences I've been attending this fall.
This market's evolving fast. The fact that you're all engaging in different types of partnerships, you're mixing it up with some of the incumbents. The next question is all about kind of what happens next. So technology enablement legislation, the emergence of the so-called millennials, are often cited as the important catalyst for further growth in the crowdfunding market. The winners seem to be on both sides of that trade, and they're people like you and me, they're investors or people raising capital. But for each of the markets, could you project forwards who are the big potential losers? And how, if at all, will they respond? I think we've started to see some of the response come in some of those answers already. What are the early signs that you're seeing that the incumbents are responding, and where do you think we'll be in 5 to 10 years?
So I think the biggest potential losers in this space, at least the marketplace lending industry for unsecured consumer credit, would be the financial institutions, the community banks, regional banks, national banks, and even credit card issuers that do not adopt to the new trends of marketplace lending and are not adopting to meet borrower needs and desires. Borrowers are seeking a frictionless, fast, very, enjoyable experience borrowing money online on convenient terms, on their terms, when they like, late at night, early in the morning, whenever, and are not subject to branch-based hours or brick-and-mortar locations. And I think those groups that adapt to that new environment and the changes in consumer behavior, especially with the new millennial generation coming up and coming of age, those will be the ones that the ones that do adopt will be the ones that benefit. Those that do not adopt, I think, bear the biggest risk of loss of their best customers. And I think you're already seeing a trend of banks partnering with the Prospers and lending clubs of the world. They're both referring borrowers and originating assets for their own balance sheets. I think you'll see that trend continue, and I think you're seeing larger and larger financial institutions partner with the Prospers and the lending clubs of the world in order to meet their objectives and really benefit from this new technology and these new trends.
I think in the equity crowdfunding space, the first losers are the venture capitalists, and it's not to say we don't work together. We can partner, and I think that there's room. It's not a zero-sum game. There's room to partner, but a lot of these deals, we've entrepreneurs who have sort of soured on traditional funding sources and come to OurCrowd, particularly because our model is not just a crowdfunding model, but we actually, I don't know if there's a better term, but it's like the equivalent of online venture capital, where we do diligence, we do support companies after we invest in them, and have a portfolio management function just like a regular venture capital firm would. The other thing which may be surprising, I think actually stock markets lose out. I think a lot of the capital we're seeing from the retail investor base, this is money that would have been earmarked to the stock markets, to mutual funds, to pension plans. This money is instead coming out of the market or not entering the market at all, and coming towards a new form of investing, which is equity crowdfunding. So I think, at least on the retail side, we're going to. I think the losers are the brokers or the actual stock markets themselves.
Thanks, Zack.
I think it's the funding sources which do not adapt to transparency. Because if you look at marketplaces like ourselves and the others on this panel, what they truly promote is also transparency in some form for investors to be able to look at all the deal-related information online and discuss it with like-minded individuals. And also for, in our case, property developers who can come to a platform like ours, get all the information they need, and also get a service beyond just money, where we deal with the investors and the reporting, keeping it transparent for our investors, just in terms of providing the service.
Okay, so I was going to talk about the banks, but I think we did a good job of that already. So I think aside from financial institutions, I think the other kind of group of people that stand to really lose is the public market participants. So one interesting trend that we've seen over the last 15 years, and which is accelerating now because of the advent of platforms, is that private companies are staying private a lot longer before they IPO. So today, basically, private companies are staying private about twice as long as they did 10 to 15 years ago. And if you looked at 15 plus years ago, you had companies like Microsoft, Amazon, Cisco. They all IPO'd for just around $500 million. And then while they were in the public markets over the next 15 years, those companies appreciated by, on average, about 470 times what they IPO'd at. So hundreds of billions of dollars were created, a value was created in the public markets. And now you look at today, and you had Alibaba IPO for over $150 billion. You had Facebook IPO for $100 billion. And so for those companies to appreciate by 470 times in the public markets, one of those companies alone would have to be worth more than the entire global stock exchange. Mm-hmm. So, it really shows you that because of more capital being available in the private markets, and platforms are a big part of that, and because of some of the regulation which is changing that allows emerging growth companies to stay private longer, so the increase in the number of shareholders and some other things, you're seeing the shift in value capture from public markets to private markets. And so in terms of, are we already starting to see some signs that people are paying attention? Absolutely, absolutely. So if you look at a lot of hedge funds and you look at mutual funds and you look at the capital inflows to private deals versus last year, it's up over 50%. Same thing with, if you look at the corporate VCs, it's pretty incredible to see kind of the year-over-year growth in venture funds getting started by corporations that are trying to get access to private markets. And then we talked a little bit about the exchanges themselves already, but you're seeing the New York Stock Exchange start to get a lot more aggressive on getting access to IPOs. You saw Duncan, I think a month ago, leave as the head of the New York Stock Exchange to join a company that's actually helping with private placement. So we're absolutely starting to see a lot of these trends, and I definitely expect that to accelerate.
Yeah, in the online market, online lending marketplace, we're seeing a lot of new players entering the market. It seems like every week you're hearing about some new, platform that's launching. And some of the things that concern me, at least, is that I'm seeing that there's a lot of also very demanding investment groups out there that are really seeking and chasing yield, right? And I think what's going to happen is as these new players start to try to differentiate themselves, one of the ways in which they think they're going to be able to do this, and time will tell, right, is that they're kind of swimming downstream from FICOs and making riskier loans, which in turn at least appear to be driving higher yields. And I think that there's a lot of risk involved there that because you won't know until 3 years, 5 years out when these portfolios fully mature, that could be very problematic for some of the newcomers getting into the space. There's also a lot of, regulatory risk. There's operational risk. There's fraud risk. There's technology risk. And I think that a lot of these newer players, maybe at this point, maybe they haven't figured out exactly how to create a stable and scalable model. So there's also a lot of risks involved with that. So I think that you could see some losers coming out from all ends of the spectrum, but it concerns everybody on a larger scale, because if one goes down, obviously it doesn't fare well for everybody else who, may be more thoughtful and deliberate in handling their underwriting processes, at least from our perspective on online lending and underwriting. So I think there could be some real problems kind of occurring in that area.
Does anyone have a view on what the smaller local regional banks, the kind of 5 to 10 branch banks, might do? Because it feels that as this goes closer to small business lending, they could be at risk as well.
Right. Well, it does seem like, and you'll see it already, a lot of the community banks are now coming around and they're saying, hey, look, these online lenders are getting it right. Why don't we team up with them? I mean, I just ran into a regional bank last week at a conference, and the discussion with the CEO was, hey, we're willing to even put up marketing dollars. We get it. We like the idea of being able to plug right into your system. It's automated. You know what you're doing, and you're good at it. And we could leverage that and maybe replicate that in other areas. And you're seeing that with the other players right now, and the banks are starting to come together. I think the big problem with that, like any new financial market, is that everybody wants to sort of wait. And when you're dealing with a regional bank, you have board members who have probably been there for 20, 30 years. They like, they're fine the way things are, and it takes time to convert them into believers and understanding that, hey, the world is changing and you have to change with the world if you want to still serve your community in a meaningful way, right?
So we also do a similar conference to this. I think it's in the first or second quarter of the year, and it's targeted at our large wealth and online clients. And I asked the audience, and I was on a panel talking about crowdfunding. I asked the audience, how many of you have used one of the platforms such as Lending Club or Prosper? And I think 1 out of maybe 130 people, and these are senior executives who were really aware of what was going on. And I think there is a sense of maybe it will go away. And there's also the innovator's dilemma, right? It's very hard to take a step forward when you might be cannibalizing your own business. The big banks make a lot of money out of their credit card underwriting, for example. So let's go into my final question. I think we might have some time for audience questions as well. What further enablers are required to make this a really big thing? I mean, I think we all see the potential, but it's a bit like the ETF market. It took quite a long time to really get going. The formation of secondary markets, is that part of it? Is it further groundbreaking legislation? I think we're still waiting on Title III. Is it further? Is there a strategic shift to come perhaps through a new entrant? We saw Google last year starting to dip their toes in. Is there a new big disruptive player about to enter the market? Any thoughts on that, gentlemen?
I mean, I think what could really make things change the market environment and really grow it significantly would be broader awareness of the borrower by the borrower community. I think the thing really constraining at least Prosper and Lending Club, and it sounds like some of the equity crowdfunding platforms as well, is quality deals. For us at Prosper or at Lending Club, it would be quality borrowers to underwrite, and for the crowdfunding sites, it's quality deal flow. But I think if there was a larger awareness by the borrower community at large that you could go online, get your money very quickly at rates that are generally better than other forms of unsecured borrowing, and have a great experience, and it's very quick and easy, I think everyone would borrow money in that way. So as you see a Lending Club IPO and additional efforts made by the platforms to educate the borrower community, you'll see tremendous growth. I think the awareness is the one thing that's necessary to really propel this to the next level. That and continued transparency. As a marketplace, you're built on trust from both your borrowers and your lenders. Your borrowers are saying, or investors rather, borrowers are saying, can we get the loan as promised at the rate promised and the speed promised? And investors are saying, can we actually invest in this paper or this loan and get the return that we're promised at the loss rates that we're told we're going to expect? So I think those are the two biggest things for us.
Thanks, John.
Kind of echo that. We're not looking towards Title III. I'm speaking from the OurCrowd's perspective in the business that we're in. We're not looking towards Title III as sort of a panacea for the industry. I don't think we're even going to go after that business. And I think you could debate whether, for the end investor, Title III is a very productive thing. I think it's more brand equity, and I've consulted to many large financial firms in the world, and they've spent billions and hundreds of billions of dollars building their brands over time, and so if we're taking share away from them, I just having walked through the crowd, nobody heard who OurCrowd was, and you guys are in the industry, so it's like it's going to take time, energy, and money, and more fundraising essentially to get the awareness out. The other piece I would highlight are better tools to be able to assess for the end investor and to compare investments. So it's interesting that Ryan, has a lot of the same metrics. I think we see a similar business. I don't think we want to expand more than 2% of the deals that we see getting onto our platform. But how does the end investor compare an early stage deal versus sort of a mid stage deal? What's the risk implied? Like, why are terms better for one and worse for another? How do I build a portfolio of all these things in a way that shows best practices?
So from a capital raising perspective, definitely when institutions enter the space, that'll be a big positive for us. But just from an issuer perspective, I think it's when the bigger developers start using technologies like ourselves or the other crowdfunding platforms to source their deals through. I think that's when the industry will get a lot more credibility. And also in terms of the reporting, deals are going to go bad. It's up to the platforms like ourselves to make sure we are in constant communication with our clients, which is primarily the investors, to follow up with them and send them end of project reports if needed, or keep them updated on a timely basis to make sure that we build on the investor confidence. And with that being consistent, I think with time the industry will get a lot more credibility.
So I will argue that the secondary market is probably what is the most necessary, and as I look out 5 to 10 years in the equity space, and I guess I'll give you 2 reasons. So one is I am an avid kind of peer-to-peer lender myself, big fan of what Prosper is doing, and one of the huge benefits in peer-to-peer lending, and I think one of the reasons it's been able to take off so quickly versus equities, is that you get a quick feedback loop. So you know what your adjusted rate of return is pretty quickly, and you're getting dividends, you're getting coupons very quickly month to month, so you get that quick feedback loop. In the equity space, it's a different asset, and it can take 5 to 7 years to figure out whether you are actually making good investments or not. And same thing in the debt space, with the iFunding and companies like Patch of Land, you know pretty quickly what your actual return is, and that is a challenge with equities. So if there were a secondary market, there would be a kind of quicker mark-to-market on your investments, and you'd have the opportunity to ultimately sell if you want to, but at least you know if things are appreciating. It's easier said than done, but I think it's absolutely necessary. And then I guess reason number 2 is just that the psychology of investors. So today there are only 370,000 angel investors in the U.S., And so a big part of it is this is a brand new asset class that people are going to have to learn to understand. It's different than the public markets. And, by the way, if I'm thinking about jumping in for the first time, it really is jumping in because I'm, even if it's a smaller investment than a typical angel investment, I'm in it for 5 to 7 years potentially. But if I know that I can change my mind a few weeks later and punch out even at a discount, like the public markets, that makes that kind of leap of faith into a new asset class a lot easier for me. So I do think a secondary market is something that in the longer term is very necessary to really accelerate the marketplace in the equity space.
Yeah, I agree with that, Ryan. Michael?
And I'm going to echo the education. That's all in capital letters. I mean, there's so many people that really still don't know about a lot of these online lending platforms where they can generally get better rates and in a quicker manner. So I think that these IPOs, more infusion into the operating capital of the companies, will help to propel the message much further. You'll see a lot more mass marketing as we enter the next 12 to 24 months. But I also think that performance over time, and I stress over time, because a lot of people, generally consumer installment loans, just because you're getting paid back in the first 6 months of your loan, you're not home free, right? You have economic stresses, you have other things going on in a portfolio that change over time. And typically, that's going to start decreasing over time. So it's hard to say really what your rate of return is going to be in a vintage until that vintage is really fully matured. And I think some folks look at this marketplace and they go in and, you see a lot of the blogging going on and you have a lot of people saying, yeah, I'm getting, 12%. And this is the best thing since sliced bread. Come back to me in 3 to 5 years when your vintages are fully matured, and then let's talk, right? And we don't really know what that's going to look like. We only know historically what it looks like if you're really following the FICO numbers and you're following the historical data for FICO, but that isn't always a good indicator of what the future is going to bring, particularly in an economic downturn. So you have to make sure that when you're underwriting that you're applying stress to your different credit grades appropriately to withstand that and at least preserve your capital moving forward. So I think really it's education and performance, but over time.
Great, thanks, Michael. James, do we have time for a couple of questions? Yep.
Stand up and talk loud.
There you go.
I'm a real estate broker here in New York City, and I'm launching a private equity fund to raise money to rally Black and Latino investors. My question is, from a social justice aspect, do you think that crowdfunding can be very effective to lobby a niche market, for instance, the African American Latino community in New York City, which is very angry about the displacement of their communities, communities like Harlem and Fort Greene?
Great question.
Absolutely. That's a good question. I think crowdfunding has the potential to redefine communities. We've seen that in the past in real estate with different platforms. And it's also something we're working on right now, where we're going after neighborhoods as opposed to just an asset, and allowing individual investors to invest in the entire neighborhood, and just be a part of the development there.
I would say the answer is absolutely yes, but I don't think it's going to happen until Title III gets passed, because Title III opens up investing to the other 98% for the first time, and the beauty of that is it is more akin to Kickstarter or Indiegogo's model, where you can kind of invite anybody to invest really small amounts to support a business. And I just don't think with Title II you're going to see a lot of changes. I think it's really a Title III game, which is yet to be seen, hopefully in 2015.
It's kind of interesting that the crowdfunding and peer-to-peer lending space is kind of capitalizing on banks' lower willingness to lend as they're squeezed by regulation after the crisis. So I'm wondering, given that the scalability of this market depends a lot on the involvement of, the continued and growing involvement of institutional investors and scalability methods like securitization, for example. Michael, you kind of alluded to this earlier, that there is going to be a temptation maybe with new lenders hitting the market every day to chase yield, essentially. And I'm wondering whether the originate to distribute kind of problems that we saw during the crisis, particularly in the securitization market in the US, could end up being a bit of a concern for the online lending space as they strive to make that business more scalable.
I think about it every day, and you're right. I mean, it's no surprise that a lot of the economic disaster was a result of just poor underlying assets that were being packaged up, right? And, at least CircleBack lending and others that we work with and we're aware of that are in the marketplace now are striving to really keep the quality of the underlying assets very high. But as new players get in, there is that concern and fear that as institutional investors and other types of investors are chasing yield and pressuring, to drive yield up, it's going to present this opportunity for other folks to maybe start going downstream. And, the riskier stuff, I think it's inevitable. It will start to get packaged up and most likely securitized. And it's just something that everybody has to be aware of. And hopefully everybody has their eyes open this time when they start buying bonds, in understanding what the differences are between, a basket of loans made up of 500 FICOs and a basket of loans made up of, 640 plus FICOs and, so on and so forth. So, but it is a real concern, and I think it's inevitable that it's going to happen.
I think, just to add to Michael's point, I also think that transparency on the platform's part help maintain the integrity of the platform and the underwriting models. At Prosper, we offer over 500 attributes on each loan via the API. So all of our institutional and retail investors can go in and understand exactly what the loan looks like, what that borrower looks like, and they can sort by a number of different fields to choose only the loans that they believe meet their criteria. I think anyone that's buying a securitized product can also look at the historical data on the Prosper website and look at, okay, I'm buying a securitized portfolio of Prosper loans. I can get all the information, all the vintage information, all the loss curves. Also, because we're an SEC registrant, we file like a public company, although we're not public. There's just a wealth of information about our business, our underwriting, et cetera. I think that level of transparency will prevent the type of issues that you're talking about with people just securitizing anything and eventually hitting, crashing, I guess.
I think what's interesting to that point is, as the Fed kind of scales back its activities, it feels like the banks aren't stepping up, they've not recovered fully, or they're being much more conservative. A big question is, to what extent will this marketplace, I guess, be encouraged by that and be able to fill that market, or whether you're just going to continue to see a lot of volatility in the markets. Yep. Are we doing one more question? Yep. At the back there.
Are any of you seeing smaller or regional or more nimble traditional banks or investment banks deciding they want to enter your market directly and compete with you directly? Appreciating maybe the larger ones are a little bit too ingrained in existing business models, but institutions with licenses and technology staff and so forth, do you see that at all?
I mean, we've certainly seen a number of smaller investment banks approach us to use our technology to make their processes more efficient. So we're actually regulated, so we can do KYC, know your customer, and anti-money laundering and accreditation verification in under a minute. So a lot of these processes that just haven't changed in 20 years, whether it's, I think, what people are doing in the P2P space or the debt space or real estate or equity, it's just a lot more efficient. People were talking about it earlier with angel groups, but it's the same thing with I think, all the kind of broker dealers and investment banks. And I think if you look at companies that have gone out of business in the last 5 years, I think it's like number one is companies that made cassette cases. Number 2 is like supermarkets. Number 3 is broker dealers. So because of a lot of the additional regulation they've got, I think a lot of them know that they have to make changes to kind of survive. So we've definitely seen a lot of people trying to make things more efficient.
Well, look, thank you very much. That was a fascinating start to the conference.